Well, glad you're here.
This meeting is being recorded.
We're going to be talking about discussion
We're going to be
5,
talking about
financial analysis.
financial analysis,
We'll be going into the Google Sheet,
Google Sheets.
and we'll also be going
We'll also be
into
going
Edgar and accessing the
Edgar
data.
and access.
Edgar is the SEC,
Edgar is the
Securities Exchange
SEC
Commission website
Exchange Commission
that
website.
allows you access to all
Allows you access
publicly
to
traded
all
company
publicly traded
10Ks or annual reports. So we're going to go play with that. There's some neat features in Edgar that allows you to download a spreadsheet, and you can do some number crunching very, very quickly. Well, let's take a look. I'm going to share the screen, and we're going to take a run over to the actual discussion post requirements that is posted right now on Blackboard. As you can see, discussion 5, and today is June 15th. Tomorrow will be June 16th. Discussion 5 asks that you do some analysis, financial analysis. You're going to pick a company, ideally from an industry that you have some interest in or have some personal experience with. Maybe you want to get a job in. Maybe it's a company you do business with. Maybe you have a family member that works for the company, or just something you're curious about and may want to work for someday. I'll share with you in the career space the spray and pray method of applying to 200 jobs online does not really work real well. It's becoming much more focused that you might pick 5 or 10 companies that you are actually going to seek employment at, and you're going to do some due diligence, you're going to do some digging, but you're going to actually choose the companies first, maybe know some people, reach out and network, but you're not going to do 200 companies. You're going to, again, focus the efforts. And this is another tool and helps you to focus. And it does say doing such analysis before going on an interview can and will differentiate you from over 95% of other candidates that might be competing for the same job. If you can show them that you've actually looked at the financials and you did a little bit of number crunching, and you know that sales are up or down, or profits are up or down, or something's going on, and you can ask an intelligent question, that's a question that none of your competitors that are seeking the same job position are most likely asking. So this is a powerful place to do it. So I'm going to do it at 2 places. First, I'm going to go to a shared financial analysis spreadsheet. This is a Google Sheet. When you click on it, you'll access a blank spreadsheet, and not an Excel spreadsheet, but a Google Sheet. And there are a bunch of categories that we're going to be using here and looking at. We'll start with a company name that you pick. The stock ticker symbol would need to be publicly traded to be accessible in Edgar. We'll put your name, and here's a summer class. This is our summer schedule. Now, each of these titles, current ratio, gross profit percentage, net income percentage, you can see here, I'm going to just arrow those out. You can actually see that we're getting in the description here, there's our net income. If we go in and we actually want to take a look at the next category, we're looking at return on assets. Look at the next category, return on equity, debt ratio, inventory turnover, days sales inventory, days sales outstanding, inventory as a percentage of assets, accounts receivable turnover, accounts receivable as a percentage of assets, AR as a percentage of assets, fixed assets as a percentage of assets, change in sales for prior year, current year minus prior year divided by prior year, we'll do that. Change in net income, right? Current stock price. Now that won't be on your 10K, but you can find the stock price pretty quickly. And you know that you probably are aware the stock splits going on with Amazon. Tesla's going to have another stock split. There's also going to be, Apple had a stock split not too long ago. So the stock price is going to be reflecting of the post-split pricing. And finally, fiscal year end, and who is the auditor? Most likely one of the big 4 CPA firms, but I'm going to ask, and that is found on the 10K of the annual report. So now let's go back, and I'm just going to do a quick Google search here. I'm going to go in and type in Edgar. Okay. Now it might find Edgar Allan Poe. It might find some other things, but it typically will jump first to the SEC's Edgar. Company search page, search and access. And that's what I'm going to do. And let's go ahead and access. Well, we'll start with the basic search page. Clear out that scribble that is there. Okay. Now, if you have a ticker symbol, it's going to be a lot easier to look up a company. Because if you look up a company like Walmart, there's a Walmart Inc. and there's a Walmart Stores. These are two separate IDs. But you notice here, WMT, I do know is the Walmart ticker symbol, which is the Walmart we want. So I'm actually going to click on that. One trick in Edgar in the upper right-hand corner, I urge you to use the classic version. This classic version allows you to pull interactive data, to pull the Excel spreadsheets very gracefully. So you don't have to read the 10K and hand transcribe all the notes and all the numbers. So I'm going to go to classic version. I'm going to go to filing type. When I put in 10K, which is the annual report, and I hit return, it says nothing. The syntax is kind of important, how you type it. If I put in 10-K, we got a winner. We've got the 10K, the filing date is March 18, 22, March 19, 21, March 20th, 2020, March 28, 2019. So these are annual reports. There may be sometimes a 10-K/A or amended when they make some changes, because sometimes the first round might have some errors or need to be restated. So I'd use the most recent. I take the most recent interactive data. So let's grab at that. I look at interactive data. I've got the 10K itself. I've got notes to financial statements. I've got reports. I've got details, tables. I'm going to jump to financial statements here. And when I look at financial statements, I see a number of statements. I have a statement of income, comprehensive income, a balance sheet, shareholders' equity, parenthetical shareholders' equity, and cash flow. I will tell you, you will almost never be using the comprehensive income. Sometimes when I say statement of operations and statement of comprehensive income, you say, wait a minute, operations and income. Oh, let me go to the operations. There's a bunch of names for the same thing. It gets kind of confusing. But if you look at the statement of income right here, I've got 3 years of data. As I look at Walmart, I say, oh, I've got sales revenue. And if you tell me this Walmart have $567,000 in sales revenue, we're going to have a different conversation. I know homes in Florence that cost more than that. But the idea is this is 567,762 in millions. So I have to add 6 zeros. So 567,762 million is $567 billion, 762 million. So I'm looking at $500 billion in sales. And look at the trend. We go a trend from 520 roughly to 555 to 568. We've got increasing sales revenue over 3 years. They have membership income and a total revenue amount here. 523, 559 membership. Oh yeah, Sam's Club. They own Sam's Club. That's kind of interesting. I click on actually what this is. Amount of revenue and income classified as other. They give you some more details as you look at the subcategories. So let's go down to net income. We'll scroll down and we're going to go to bottom line. We go right before earnings per share. So they had 522 earnings per share. And if you look at the net income trend, they actually had less sales in 2020, but higher net income. Net income dropped even though sales went up from 519 to 550, I'm sorry, from 523 to 559. And then profits also went up a little bit from 21 to 22. And sales also went up a little bit. Looking at that, here's my net income number I'm going to play with. Here's my change from there to there divided by there. It's going to be my percentage change. We'll see that a little bit later on. So this is an income statement summary. Let's look at a balance sheet summary. Here's our balance sheet. Now, if all goes well, this 244, 480, and 860 rather in millions, meaning $244.9 billion equals $244.9 billion liability plus equity. So our balance sheet's in balance. That's a good thing. You'll notice our income statement had 3 years of data. Our balance sheet had 2 years of data. And for some ratios, you might have to take average receivables or average inventory. And when you do that, you say, wait a minute, I can only get one of those ratios. I can get my 2022 inventory turnover ratio. I can get my 2021 inventory turnover ratio only if I have 2020 data. So I'm going to have to go to last year's 10K to extract that data if I want multiple year analysis and to really investigate fully how a company's doing. So let's talk about why we're doing this in the first place. We are going to analyze financial ratios And there are three kinds of analysis. One is ratio analysis. That's a lot of what's in that spreadsheet. So we got the current ratio. We got debt to asset, debt to equity ratio. We've got other ratios that might be inventory turnover, receivables turnover. That's covered in chapter 13, which we smack dab in the middle, which you're covering in the homework. We also have horizontal analysis, which is called trend analysis. So if I look at sales last year to sales this year, did my sales go up or down? Oh, it increased. What percentage did it increase? Okay, that's horizontal, change from year to year. And my sales changes, my SG&A, selling general administrative, my net income changes might be different. And then I do vertical analysis. Vertical analysis, also known as common size analysis, says, well, if my sales number is 100%, my net income as a percentage of sales might be 4% or 8% or 22%. Or on the balance sheet, my inventory as a percentage of assets might be 25% or 40% or 10%. And then you can compare last year. How was my inventory as a percentage of assets last year and my inventory as a percentage of assets this year? Because if I told you last year inventory was 5.6 billion, you're going to say that's a lot of inventory. But it's kind of a meaningless number. But if I was able to tell you that last year inventory was 15% of my assets, and this year is 20% of my assets, that means my inventory has risen as a percentage of my assets. It means I have more inventory to sell. And it can mean a couple of things. It might mean I'm more inefficient. I've got more inventory that's not selling. It's got me stuck with it. Or I just have more things I can sell, which is going to help me with sales, because if it's not on the shelf at Walmart, I'm not buying it. So you have a chance to buy stuff, and you can actually see, Walmart had some major inventory problems a few years back. They couldn't keep the shelves stocked. Now with supply chain issues, a lot of companies are having trouble stocking their shelves. And with inflation, probably they maybe have easier time stocking their shelves if people aren't buying and the stuff gets more expensive. So now let's go through, and I'm going to go back to Edgar, and I'm going to go one step further from this financial statement stuff. I'm going to point out this View Excel document. This View Excel document, I'm going to click on it, and we're going to get tabs for a statement of income, tabs for comprehensive income. So if I go View Excel document, you're going to want to do this. You're going to want to go ahead and we will retrieve the Excel document. And we'll take a look at these tabs at the bottom. I've got the cover page. Okay, 10K, period, document end date is January 31 year end. One thing you're going to want to do first thing is enable editing. So I want to be able to put formulas on here and do some calculations pretty gracefully. So let's go ahead and actually I'm going to stop here briefly. Delante, any questions so far? Are we making sense?
No, sir. Makes sense so far.
Making sense? Okay. Then I will continue onward and upward. So let me go ahead back to share.
Go ahead, back to share.
All right. So I am now on the cover page tab. I go to audit information. We actually had the question, okay, tell me about the auditor. Okay, well, the audit information is EY. Actually, you used to work for, it was Arthur Young when I was there. It was part of the Big Eight. Now it's Ernst & Young. So it's part of the Big Four. So EY is the auditor out of Rogers, Arkansas. Right, no surprise, because Walmart's out of Arkansas, right? But their office down there that services Walmart, that's where they're based, but they're global, they're one of the Big Four CPA firms. So there's one of the answers to our question, who the heck is the auditor? Here's our consolidated statement of income. I'm going to shrink this down a little bit, move this over just to see it a little cleaner. And go ahead, push that down, play with that a little bit, a little bit. And you're looking here, here's my net sales. And by the way, good format says the top has a dollar sign on it, the bottom number has a dollar sign on it. All the rest have the commas, no cents, but just dollars. We know it's in millions. And we can do some very quick analysis. I'm going to do a vertical analysis here, which will answer a number of the questions that we do. So I'm going to go ahead, I'm going to insert a column here. And I'm going to make total revenue is my 100% number. Equal that slash that. Turn this column into a percentage. And I'm going to go ahead and move the decimal over a little bit. One or two decimals is good. Now I'm going to actually adjust this. I'm going to make this $P. It's called absolute referencing. And when I copy the cell, it's actually going to copy. It's going to change the B6, but the $B, $6 is not going to change. I'm going to Control C here. Copy it all down here, down to the last number here. And if you look at these percentages, my total revenue is a 100% number. Let's make it a little bigger so you can see it cleaner. And my cost of sales is 75%. I'm going to insert a gross profit line here. Okay, so I want to insert a row, and I'm going to say gross profit. How do I calculate gross profit? I'm going to take my total revenues. Oops, let's try it again. Equals my total revenues. Get this thing that you can't see in the way. There we go. Total revenues minus my cost of sales, or cost of goods sold, or cost of product sold, or whatever you want to call it. I'm going to copy this formula across here. I'm just going to make that. So my gross profit is $143 billion. My gross profit percentage is 25. What's this telling me? I think we used earlier in the class, we had a $2 a gallon of milk. Our cost of the milk is $1.50. Our gross profit is 50 cents. Okay, I mean, I just doubled the two, the 1 to 2, the 75 to $1.50, 25 to 50. Then I went to bottom line. I double that. I made 4.8 cents on selling a gallon of milk. Less than a nickel. Overall, because I'm adding all my other expenses, SG&A and operating expenses, and I have my debt, my interest, and all the other expenses associated with that. So if I ask what's my gross profit percentage, here's my answer: 25%, 25.1. If I ask what's my net income percentage, 2.39%. Let's look at a couple of other ratios. I mentioned I want to calculate change. Okay. Change, we'll call it change from prior year. And we'll do it for 2021 to 22. We'll do some horizontal analysis. How the heck do I do that? I'm going to take equals my current year minus prior year, that minus that, close parentheses, and divide by the prior year. So, and I'm going to convert this to a percentage as well. So all percent. Actually, I'm going to make it, again, give it 2 decimal places. So we're going from 555 to 567 is a 2.26% increase. Now I'm going to copy that formula all the way down. And actually, it's dividing by 0, so I'll just clean it up a little bit. So my net income increased 1.2%. My sales went up 2.26%. So my sales grew faster than my net income did. My income taxes went down substantially. My interest income went up, but again, as a scale of things, we've got net interest. My operating income is up 15%. Let's get rid of this divide by 0 thing. Okay. So I just did a horizontal analysis on my income statement. I did a vertical analysis on my income statement. I can do the same thing in my balance sheet. Now let's look up the formula for inventory turnover. And I'm going to have a conversation about that first. I'm going to set up I'm going to go on the whiteboard and we'll take a look at that. The current ratio is pretty logical. Current assets over current liabilities. The debt to asset ratio is pretty logical. Total liabilities over total assets. And we'll do those in a few minutes. But if we have a mixture of a balance sheet item and an income statement item, so the one we're going to analyze is something called inventory turnover. How fast do I sell my inventory? The two things that make up inventory turnover, one of them is inventory, obviously. That's based on the stuff and the cost we pay for it when we buy it. The other is cost of goods sold, or cost of sales, or cost of products sold, COPS. So my first question to you, which is a bigger number? If I'm looking at a graph and I'm looking at dollars over time, what happens with inventory? Well, I buy some inventory, I sell some inventory. I buy some inventory, I sell some inventory. I buy some inventory, I sell some inventory. That's the graph or chart, my inventory over time. But let me ask you the question now. What is cost of goods sold do? Well, I sold some goods. It cost me money. I sold some more goods. 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 So which is a bigger number? Cost of goods sold or inventory? Well, it doesn't take a lot of reading a graph to understand that. Well, cost of goods sold sounds like the bigger number. So I'm going to put cost of goods sold in the numerator. And that cost of goods sold is a telltale sign of what we're trying to analyze. So I'm going to cost of goods sold. And the catch here is I can't just put inventory. I'm going to have to put average inventory into my denominator. So what's that tell me? If I have $20 million or $20 billion in cost of goods sold and $5 billion in inventory, my inventory turned over 4 times that year. But every 3 months, I sell all my inventory on average. Now, I might sell some stuff in a week, and I might sell some stuff in 6 months, and I might have some stuff that never gets sold or that gets broken. This is one of those ratios you look at and say, you know, I like my inventory turnover to be faster. I don't want to sit on things for 2 years, a year, 8 months. You know, if I can turn it over 3 months, every 2 months, that's actually better. I'm actually selling more and having a consistent movement of my inventory out the door. But why did I have to do average? Well, cost of goods sold is over a whole year. So we're looking at cost of goods sold cumulative for the year. That's cost of goods sold is an inventory item. It's a period, a income statement item. It's for a period of time. So I'm looking at that period of time saying, okay, great. I have my cost of goods sold over this period of time from the first of the year to the 31st of the fiscal year, 12 months worth of stuff. But I'm taking my average inventory. Well, balance sheet is a point in time. You know that. I have a point in time where my inventory on January 1st and my inventory on December 31, if I have a December 31 year end. I average that inventory for the year. Now I do the same thing for receivables turnover. I look at receivables, which goes up and down and up and down and up and down, and sales, that's the other number in receivables turnover. My sales keeps going up, 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 up. So my sales will be in the numerator. My average receivables will be in the denominator. Those are two of the ones you got to kind of memorize a little bit when it comes to ratios. Again, most of the other ratios are pretty intuitive. So let's go back, and I'm going to go ahead and clear this, and we're going to go through and take a look and see if we can mix our balance sheet items and our income statement items and go back in our analysis on the spreadsheet. So I told you I need 2 things. I need my cost of goods sold. It's called COGS here, cost of sales. That's what the terminology that Walmart likes to use. And I need average inventory. Now I could do this in one formula, but I'm actually going to do it here just so you can see how we calculate it. So what's my cost of goods sold? My cost of goods sold, I'm going to do an equal sign. I'm going to go over to my number of 499, where's my cost of sales? 429,000 billion. So there's my cost of goods sold. Now, what's my average inventory? I have to add my beginning and ending inventories, or last year's inventory and this year's inventory, and divide by 2. So I'm going to do equal, open paren. Now I'm going to go to not my statement of comprehensive income, but I'm going to go to my balance sheet and take my inventory balance here of 56.5 billion. Add to that my 44949 and close parentheses /2. See what I get over here. Oops, see it. So this is coming from IB5, IC5, divide by 2. An extra paren in there that I shouldn't need. That in there, I'm gonna take that out. Okay, so my average inventory is 5730. Just to make it look pretty, I'll put the comma in there so you can see it. And you say, oh yeah, that sounds about right. Now my inventory turnover is calculated. I'm going to take equals my cost of goods sold in the numerator, divide it by my average inventory denominator, and I get 8.46 times a year. And I'm going to calculate days inventory by dividing by 365 into that. So 365, I need equal sign. We're doing Excel. Equal 365 slash 865. So what this is telling me, every 43 days, about every month and a half, I'm selling all my inventory, or Walmart's selling all its inventory. Is that good or bad? That's the question we want to answer. Well, the reality of the question is we don't know. What was last year's inventory turnover? Oh, I got to go back to the previous 10K to do that. And you can do that if you like. But for this assignment, we don't have to. But if I said last year our inventory returns were 7, that calculates that and equals that, that means, oops, make this formula correct, equals that, equals 365. So it'd be 52 days. It was slower last year if that was the numbers. So it's typically faster, better? Typically, yeah. Can it be too fast? Can I have 10 days inventory? Yeah, you could, and that would be much too fast, most likely, because you couldn't stock your shelves fast enough. So the absolute numbers aren't as meaningful as the relationships of the numbers. Okay, let's go back to the balance sheet. And I'm going to play with a few more numbers here. I'm going to insert column between these two. And let's do a current ratio. So well, let's do a vertical analysis first. Remember we did that total, we said total assets is the 100% number equals that slash that. Make this column percentage. I'm just do one decimal place. I actually put one easier to see, less numbers to worry about. And I'm going to change this $B, $13. Go ahead and say, oh, let's copy the hell of this thing all the way over to equity, all the way down to my totals. My totals better be 100%. There we go. My total liabilities and equities is 100%. My total assets is 100%. So now I've got some answers to some other of those questions. What's my inventory percentage? Well, my inventory is 23% of my balance sheet. My receivables are 3.4%. I expect Walmart receivables to be low. Why? Because most of the customers are cash customers, or credit card, which is considered cash. So those customers are going to be paying at the cash register. You can't walk through the Walmart checkout and say, put it on my tab. Even if you have a Walmart credit card, it's considered cash. 6% of the balance sheet's cash. I might go ahead and copy this over here. And I'm going to copy this. I'm just going to say compare to last year. You might find that interesting. So last year, 7% cash. Let's copy this all the way down, and we'll just see comparisons of last year. Again, these numbers tell a story. This is storytelling 101. So what was inventory like last year? Inventory was only 18% of our balance sheet. Now notice the numbers are way up, from 44 to 56. That's about a 25% increase. Our inventory, our total assets though are down. So our inventory really jumped from 18% to 23%. That's call that a major change in inventory. And again, is it good or bad? Well, it's good if they have more inventory in stock that they can sell. It's bad if it's slowing down. That's why we do the inventory turnover ratio, and we compare it to cost of goods sold as well to get a more complete picture. Now, I might want to do a debt to asset ratio. How do I do that? I have total, that is a point in time. It's all in the balance sheet. So what's my total debt? You know what? I don't have a total debt number here. I have a current liabilities. I don't have a total liabilities. I'm going to insert a row here. And this is going to be common. You often won't find a total liabilities number. And I'm going to calculate that. I'm going to take my total liabilities and equity and subtract my total equity. I could have actually added all the numbers up here, my current liabilities and my long-term debt and my operating lease obligations and my finance lease obligations. I find it easier just take two numbers and make a calculation. Go ahead and copy that over. Make this a percentage. This percentage. Okay, got something going on here to see. 6. Oops. Okay. So last year, my total debt to asset ratio was 65.3%. This year, 62.5. So a little less debt. And if I did an equity ratio, it'd be a little more equity because that equals 100%. So my debt to asset based on total assets is debt to assets right there. Debt to asset is the same as debt to liability. I'm sorry. Yeah, is debt to asset the same as liabilities to asset. Total assets, which is the same as total equity and liabilities together. So these are some quick ways of doing analysis using Excel, using Edgar, and you see that in about half an hour, we answered most of the questions on that spreadsheet that was due. Let me go back over to our Google Sheet. And take a look at our spreadsheet. So gross profit percentage, net income, ROA, debt ratio, inventory turn, receivables, percentages, some dates, fiscal year, auditor, fill in the blanks. Just go back to your Excel spreadsheet and you're in business. I know I did that fairly quickly. This is being recorded. You do have access to the spreadsheet for review. How overwhelming was that? Or not too bad?
Not too
Thumbs
bad.
up, thumbs down, or middle? Middle. Okay. You think it would help to review it a couple times? Up a little bit.
Yeah.
I would hope so. I mean, that's why we record it.
Hope so. That's why we record it.
That's why we give you access.
That's why we get access.
Any other questions?
Any other questions?
Well, I have a question. It's not about this one. It's about the we had to download the annual report thing. That was the same as this, or will it be a whole different type of assignment thing?
Are you asking about the annual reports that we requested online from priors?
Yeah. Yeah.
The purpose of downloading those reports
Downloading the
is to actually have a hard copy of the annual report. It's like a book,
copy of the annual report.
50 pages, 200 pages.
Pages, 200 pages.
It's basically a 10K,
It's basically 10K.
CEO commentary,
CEO
has
commentary.
risks associated with the business,
Risks associated
a
with
bunch
this.
of interesting information and valuable information.
Valuable
Interviewing with a company,
information.
you read it cover to cover,
Cover to
you know
cover.
more about the industry. As I say, than anybody interviewing with a company.
Anybody
It's the company
interviewing
you're working for, you're going to say, oh,
you're working
they're
for,
doing a bonus
say, oh,
issue. Are they doing pretty well or not?
they're doing pretty well or not.
Maybe I might want to change,
Maybe
move
I
on, or
want
maybe
to
I want
change,
to
move
grow.
on, or maybe I want to
Have some
grow.
intelligent conversation with my manager or
With my
areas
manager
I want to work with the company.
or
So getting those annual reports,
getting those
if you
annual
want to use
reports.
those annual reports for this analysis, you can. I'm going to urge you to go into Edgar though.
urge you go
Access, not the hard copy report.
Not the
I just want you to have those in hand.
I just want you to have those in.
And they're going to become collector's items.
And they're
Those are going to be
become
stopped being published. They're going to be all online,
all
access,
online,
virtually, ebook, and you're not going to really ever need
Really
to get a
ever
hard copy of reports. As you can tell, I like books, okay? I like hard copies. Got a bunch behind me. But those are really easy to read.
really easy to
And,
read.
you know, bathroom reading, rather than take a laptop, it's easier to take a little pamphlet or book. But it's kind of something that
It's kind of something that
you'll have in your hands and say, this is
I
kind of
have in your
interesting.
hands.
And you can kind of thumb through it easier than you can online.
Easier than online.
But the analysis, downloading those Excel spreadsheets,
Downloading
is amazingly powerful. Doing the number
powerful.
crunching is
Doing
powerful.
the
You'll use it in finance courses, you use it in management courses, you use it when you do analysis of other companies.
do analysis.
Even I just read today, marketing managers, you do analytics, number crunching. I'm not going to apologize for it. That's what they do. Managers do the same thing. Any major, okay, finance, econ, obviously. But you're going to have these tools in your hands that you can go online and do a very quick analysis,
Very quick analysis,
just like we did today.
just like we did today.
Look at some numbers and gain some insights.
Numbers. Gain some insights.
As you review chapter 13, understanding a better interpretation of what some of these ratios mean,
What some of these ratios mean.
but it's really going to be an easy
It's really
thing
going to be
calculate for
easy
you
to calculate
once you get comfortable with Excel,
Once you get
once you get
Excel,
comfortable accessing Edgar.
access
Pretty well slam
pretty slam.
I'm going to go ahead and stop the recording.
Stop recording.
Thank you for your indulgence.
This
Oh, thank you for
This
asking
meeting is
questions.
being recorded.
You were talking about the ability to do it by hand. I know you started doing this manually and you're saying that's a lot of calculations. And then you saw me do it in Excel in, in 30 minutes or less. And again, the advantage of Excel and watching a YouTube video is you can pause it, you can slow it down, you can accelerate it, you can replay it. So in about 30 minutes, we got almost all the calculations done. If you're doing it manually or by hand or reading the annual report and posting numbers and taking out the calculator like a mad dog, 2 or 3 hours later, you'd be done. And if you made a mistake, you'd say, oh, wait a minute, what number? I think I punched the wrong number. It's a lot easier. And again, that's the power of Excel. That's where we want to be able to be using that because you're going to use this in finance. You're going to use it in management, marketing, all these other classes. And when you get your job, you're also going to be doing the analysis. When I went to buy a house, I calculated dollars per square foot on like 10 or 20 houses. My daughter just bought a house in Baltimore. I sent her a spreadsheet that had, okay, here's a 15-year loan, here's a 30-year loan, here's the different interest rates, 20% down payment, 5% down payment, and here's property taxes based on what you're buying, and Baltimore has a transfer tax, and it was all integrated, and she could punch in a number of a house purchase price, and she could have her payment in seconds. And yes, you could do it on a calculator to calculate a payment and punch in a bunch of numbers, but now you got one payment. Oh, the interest rate changed. Oh, let me hold on. Oh, here's my payment. I can get 30 payments just like that in Excel. I'm buying a car. If I need a car loan to do that, I can get the same thing on car loans. Do I let GMAC finance my GM vehicle, or do I let the credit union? And most likely it's a credit union, by the way. But the GMAC says they have no interest. They're going to charge me less price for the car, or I can negotiate the price of the car and pull in a credit union loan, which is a lower payment. Which way do I pay less money over the life of the loan? So you can do Excel is gold for that kind of stuff. So adding these tools into your toolbox and being able to use them for other classes for your future is powerful. So that's why I just wanted to make sure you had a handle. This is going to be posted on YouTube, or you're finding it on YouTube. It'll be posted in our Blackboard as well. So you will have access. This is due tomorrow night, midnight, this discussion. But once you do the calculations and pull the numbers over, you'll be able to see things and read into those. And then when you do chapter 13, you'll have a better understanding and be able to go back to that spreadsheet and compare notes. Now, some of you might do the same companies. You're asking me, what company should I do? Where are your interests? Okay. Are you a Harley fan? Okay. Or a Ford fan, or GM, Chevy fan? I'm not gonna make a judgment call on either one of those. Or maybe I'm into electronic arts. Maybe I'm into Microsoft. Maybe I'm into Activision that Microsoft just bought. Or maybe I'm into travel. Maybe I want to do an airlines. Maybe, I've been thinking in my career, manufacturer, GE is here in town. Or I'm looking at other companies. Maybe I want to take a look at either local or global companies that are US based, that are publicly traded. Maybe I want to check out Best Buy. Okay, I'm a bike guy. I look at Harley Davidson. Maybe I want to look at Apple, Microsoft, Intel. Yeah, chips are big news. Taiwan has the biggest chip maker in the world. They make about 50% of chips. Intel's a pretty good producer too. So I'm looking at those companies. What's something of interest, an industry that you might have some interest in? What's an area that you might want to learn more about? Because when you read these annual reports, the numbers tell a story, but the 10K, the annual report itself, also tells a story. And it talks about the jargon, it talks about the terminology in that industry that you can, will, and should pick up, especially if you intend to work in it or have some more familiarity with it. Nucor is a great company, and they pay really well here in town. Sunoco is a great company, 20,000 employees around the world, based right here in Hartsville. So these are companies you may or may not know much about, but this is a great way to find out more. And again, if and when you interview with some of these companies, you do a deeper dive, you got some more information than your compatriots that are trying to apply for similar jobs or internships. Please do take advantage of doing this kind of research. And when you do your managerial capstone course, you'll do some company research too, company analysis, compete. And you might compete with see other folks in the industries that you are analyzing and looking at. Finance the same way. I mean, debt capacity, debt ratio. Why do we ask for the debt ratio? Well, debt versus equity. Those are two ways to finance a company. I've got 80% debt, 20% equity financing. I don't have much more slack. I can't go to 90 or 95% debt. But if I've got 40% debt, industry averages in 60 or 65, I can actually go to the marketplace and pick up some more debt at reasonable rates, like most likely. And I have more debt capacity if I want to do that, rather than having to sell stock to raise funds and dilute ownership. Yeah, those are finance terms, economic side of the house. But all majors are and can and will be effective. So thank you for asking. I think we're on track. Pause again.